Wagwan and welcome to yet another episode. And in today's episode, I'm going to talk about how to trade a pullback because you understand that pullbacks in the markets they are very significant, or they play a key role in terms of positioning yourself or getting yourself ready to look for some trading setups. All right, and with the pullbacks, of course, it will able to help you to master entries with precision, patience, and risk control. Right. So even as we dive into this, let me share the chart because most of the things will be looking in the charts. And these are the charts, right? This is my chart. I believe you can be able to see my chart there. And I will take a new pair that I've not really drawn a lot. So I will use this for illustration. And yeah, so let's look at it. So we are talking about pullbacks. So what do you understand by pullback, or what is a pullback in the financial market, right? So even as we get, before we look at the charts, it's important to understand pullbacks. And we can say that a pullback is a temporarily or just a short-lived counter trend move within an existing trend, right? Within an existing trend. So, and what the pullback does is that it offers low risk entry opportunities, and that is after the market pauses or retraces. So you need to think of it as buying the dips or selling the rally, right? Buying the dips or selling the rally. Strategically, of course, not just random, but we are looking at it strategically, which I'm going to show you in the charts even as we proceed. So, and you realize that some of the reasons why these pullbacks are very significant in the financial market. Number one, it's they will help you to avoid chasing the price. So if you are this kind of a person who trades a formal, at least if you wait for the pullbacks, it will help you to be able to avoid chasing the price. That is you wait for the price to enter at a value zone. Remember, the value zones are very important. And what do I mean by value zones? So value zones, these are points of interest, right? Either the demand levels, the supply levels, the bullish order block levels, the bearish order block levels, or maybe probably the support levels or the resistance levels. These are points or zones of value, right, or points of interest. So the pullbacks will help in terms of confirming a trend strength before entry, because if the market pulls back, of course we want to align ourselves with the market structure, right? So we are looking at maybe probably in an uptrend where the market pulls down and respects the swing lows, right? So maintaining this the market structure. So it will help in terms of confirming the strength of the trend, and we are going also to look at that in the charts. So also the pullbacks will help you to have high risk to reward ratio setups, because in the financial markets, for you to have longevity in the markets, because you'll always take some losses at some point. So to counter those losses, it's always good, or the reason why we always advise, don't take trade setups that have a risk to reward ratio of less than 1:2. Okay, so, and especially if you're a beginner, you should be looking at trade setups that have a higher risk to reward ratio. That is probably 1:3, 1:4. Basically, because as a beginner, the number says that 60% of your trades will be losses, and 40% of your trades will be winning trades. So it is important to look at those markets in that form, in terms of risk to reward ratio. Okay, so but don't worry about that. I will be doing another video basically dwelling on the risk to reward ratio, so that you can be able to understand exactly what I'm talking about. So, and also the pullbacks will help you to master your psychology, because what the pullbacks does is that they improve emotional control and patience. These are part of the trading psychology, right? So because if you take a trade from a point of pullback, therefore it will help you in terms of managing your emotions, because you'll not be worried, you'll not have fear, right? So, and then it will help to build the patience, because you have to wait for this trade to retrace or to pull back to your level of interest. Okay, so, and when we talk about pullback, how does a pullback happen? So a pullback happens when we have a rally, right? When we have a rally, like in this scenario, we have a rally, all right? The price is rallying from let me share the screen so that you can see that. Okay, so from this particular point we have a rally. So that is the characteristic number one. We want to see a rally. Then after the rally, we want to see the pullback. So this is the pullback. Okay, so, and you find that in terms of impulsive move, we have a very strong push. All right, so we have this kind of strong push. So after the strong push, we have a down push. Okay, or a retracement. This is a strong push. Then we have a retracement, a strong push, a retracement, a strong push. All right, so then the retracement is usually a temporal correction or a short-lived correction. All right, so, and then now we see the continuation. That is the return to the trend direction. All right, so I've mentioned three characteristics for you to be able to identify a pullback. Number one, there has to be a strong trend push, either upside or downside. Number two, there has to be a retracement, and this retracement is temporary, right, or short-lived correlation. Then number three, there should be a continuation. That is the return to the prevailing trend, whether it was an uptrend. So we want to see the continuation of the uptrend. Whether it was a downtrend, we want to see the continuation of the downtrend. Okay, so the key thing or the best advice here is you wait for confirmation of continuation of the trend before entering. So after pullback, you have to wait for the confirmation, right? And the confirmation now here might vary depending on the different structures that we different trading strategies that we use, and I'm going also to illustrate that in a few. Okay, so how do we identify a valid pullback? Because not all pullbacks are valid. So how do you get a valid pullback? Number one, for a pullback to be valid, maybe I can illustrate this one. If we are in an uptrend like this, all right, so let's say this is an uptrend. So the pullback, this pullback we are talking about, or even this pullback here, so it has to see, we have to see these sequences of higher highs and higher lows. All right, higher highs and higher lows, and then the retracement, which is this price here, this is what we are calling the retracement. This move here is the retracement. All right, so maybe I can mark with a different color. So this move here, sorry, let me mark it with a different color. So this move here, this is what we are calling the retracement, right? That is what we are calling the retracement. So this move here is the retracement, because this is an uptrend. So it's creating higher highs and higher lows. So what we are saying is that this retracement should not violate the lows here, all right? So it should not go below these lows here. Okay, so, and then if you use other indicators like the volume profile, then we want to see maybe probably decreased volume, all right, during pullbacks, all right, decreased volume during pullbacks. And then now you use confirmations like rejection candles, or maybe structure shift in terms of confirming a valid pullback. Okay, so in a downtrend, of course, the reverse is true. So when we have a downtrend, this is how the market pushes. So it's creating lower lows and lower highs. All right, lower lows and lower highs. So during this pullback, this is a pullback, right? And also this is a pullback. So we don't want to see the price violate the previous swing a lower high. So if the price comes and breaks above that level, then this is not a pullback, but it's a potential reversal, right? But a pullback is whereby we want to see the market respecting the structure, right? The market is retracing or pulling back, but respecting the prevailing market structure, all right? So and some of the tools that you can be able to use in terms of confirming pullbacks, you can use the Fibonacci retracement and extension levels. So if you take your fibs and draw maybe probably from the highest to the lowest, so these are the retracement levels, the between 0.618, 0.705 and 0.79. This is ICT Fibonacci, all right? So you can use it to confirm the retracement levels, all right, before taking the trades. So also you can use, for those who use indicators, you can use the moving averages. Like for instance, the 200 moving average. When the price pushes above the moving 200 moving average and then comes back again to the moving average, therefore that's a retracement, and we are looking for the bounce. All right, they call it the bounce strategy. I think in one of my videos in the beginners forex playlist, beginners forex course, I did talk about the moving average. Maybe you can revisit that playlist and check the moving averages. All right, so you can use that. Even in this one, you can be able to use the Fibonacci. All right, so you draw from the highest to the lowest, and you can see the price coming back to this optimal trade entry. So that is a healthy pullback or a valid pullback. Okay, so also you can be able to use apart from this, you can be able to use the trend lines. All right, so you can be able to use the trend lines, and let me show you that. So if you're using the trend line, so this is how we draw the trend lines. All right, so this is a trend line. So the price comes here, pulls back to this trend line, we see rejection. It comes again to the trend line, and we see rejection. So you can be able to use that pull the trend lines, all right, to be able to give you maybe probably exact levels where the price is likely to retrace. And even in here, this one too, you can be able to use you can be able to use the trend line. So this is a very nice trend line here, the price pulling back to that, bouncing again, pulling back to this trend line and bouncing again. So this is a pullback. You can also be able to use channels. All right, so like we have always talked about the ascending channel, the descending channel, etc, etc. Okay, so as you can see here also, the price reaches the channel, pushes back again. All right, reaches this upper trend line, pushes back again. So you can also use the idea of the channels. And the simplest one again, which I began by talking about, is the market structure. When the market is creating a series of lower lows and lower highs, this is the downtrend. And when the market is creating series of lower highs, I mean higher highs and higher lows, this is an uptrend. So you can look at the market structure zones. All right, so basically what is very important is to be able to identify how to enter the market and also to exit the market. So the first thing we are going to do here is we shall come into this market. I'll be using this example of price action here, and we identify the trend, right? So here we need to identify the trend. So as you can see, at this particular point, the market was pushing on the downside, right? So we can say this was the major high, right? This was the major high. This was the major high. This was the major low. Okay, but we see the price when it pulled back here, it was unable to go below this major low, right? And also this is the major high. Okay, so at some point here, the market is in a downtrend. Remember, this is the 15 minutes structure, which is still valid in terms of trying to understand this concept. So we have the major high, we have the major low. So after that, we see the price pushing up. So the price is unable to go straight to the major high, but then it retraces back. It's unable to go below this major low to continue creating those series of lower lows and lower highs. So then it pushes up again and breaks above this intermediate high, and this is where we have a shift in market structure, right? So that is the first step, to identify a trend. So with this shift in market structure, All right, with this shift in market structure, we are able now to know that we are entering a buying program. Okay, so we are entering a buying program. So what do we want to do? To look for retracement. This was a trend. All right, so then we look for the retracement. So the first step, like I said, you can use the Fibonacci, right? Fibonacci retracement and extension. So you take and mark from the lowest to the highest level. So this was the lowest point, this was the highest level before the price retraced. And what you can see here is the price coming back to this optimal trade entry, and then now you have your setup. Remember, according to Fibonacci trading, if you're trading the Fibonacci strategy, sometimes it varies in terms of how you put your stop loss. So if this level, for instance, if you look at this level from here to here, this is quite about 200 pips, and from here to where the price went is about 400 pips. So yes, if you have a bigger account, you can have that here as your stop loss below this point here, and you can target that as long as it's giving you at least 1:2 risk to reward ratio. But again, if you have, that is, if you have a bigger account, you can take advantage of minimizing the lot size. All right, so you minimize the lot size basically to fit within the structure, but to fit within the risk management rule of not risking more than 1:2%. But in case you find yourself, probably you have a small account, so how do you go about it? So it's best to manage your risk accordingly, and you can now take your entry from here, right? So, and then you have your stop slightly below this optimal level. Okay, so I said, I repeat again, if you have a bigger account, you can have your stop there, right? And maybe probably target risk to reward ratio of 1:2. At least to that point, we have a risk to reward ratio of 1:2. It was very much comfortably achieved. But again, if you have a small account, therefore, it will be best for you to be able to put your stop loss slightly below that point. Okay, and what you can see here, we see the price rally. So of course, from this structure, our first interest will be these highs here, the liquidity levels here. That is the London highs. Okay, so then we see the price, our entry well triggered, the price coming and tapping all the way to our TP. So sometimes if you want maybe probably to day trade, you can have maybe probably even target these highs here. Remember, we have the previous highs of the New York sessions there. So, and you can have your target there. That is maybe probably day trading, and you can see the market came comfortably and took out these highs here. So that's a risk reward ratio of 1:7.74. Okay, so but for me, I don't swing trade. I don't really look at those as swing trades, not unless I take my TPs and put my partials at break even. Then I can hold the trade and let it push to the farthest that it can be able to push, because again, securing the bags, it's very important. Don't leave money on the table, okay, because it's not a guarantee that the price was to come to this level, right? So that's one of the ways that you can be able to look at that. So let's now do away with the Fibonacci. So another way that you can be able to look at it is this. So as the price was pushing up here, so it also created BOS at this particular point, okay, that particular point. So how you can look at that is maybe probably mark this. All right, you can mark that as your order block, right? So you can also use the order block. So once you mark this as your order block, what you realize here is that the price came to almost that order block, but with the aspect of the spreads, because sometimes the trading view doesn't show you the spreads, with the aspect of the spreads in view, you might realize that this level was probably activated. The price activated that level. But even if it didn't activate, let's say maybe probably it didn't activate because we don't want to force setups. So we still have the price rally, right? Again, create these highs here. So then we have our order block here, right? So this is our order block. Okay, so the first point, remember the first point, what you are looking at. So let's mark. So here we have the retracement. which came and was activated. We have the rally, we have the retracement. Using the fib, you take the entry. All right. Then we have another rally. Remember, we are uptrend. We confirm that with the shift on market structure. Then we have another rally. Then we have a retracement. So, and then we have our point of interest, right? I know this is 15 minutes time frame. If you go to 5 minutes time frame, you realize that this was a very nice OB. You could have minimized your risk to that level. Okay. And then the price comes, and then we have another rally. Okay. So we have another rally. So basically here it's an order block from the 5 minutes time frame that now gives us an entry, right? So that's a confirmation. And here you can be able to see the rejection candlesticks here, the long wicks here. You can be able to see them, basically suggesting even more bullish prices. Again, even in this pullback, you can see when the price pulled back here, you can see we have a gravestone, a dragonfly doji, which shows more bullish prices. Okay, so and if you take that kind of an entry, therefore, if that is your entry, your stop loss should be slightly at that particular point, and then you should be targeting these highs here where the price came. Okay, so that risk to reward ratio of 1 is to 3.45. If you're not satisfied with that, maybe probably now you can look at these other liquidity level here, the previous day's New York high, right? And that gives you a risk to reward ratio of 1 is to 6.3. Okay, so if you are looking at these levels here, the best thing is that the moment the price maybe probably takes out these liquidity levels, then you want to take out, you want to close partials or take partial profit and put your stop loss at break even. Putting your stop loss at break even means putting your stop loss at entry. Okay, and then now you hold and wait for the price to continue pushing to your direction. Okay, so as you can see, that's a very nice a very nice example to be able to look at that. So let's look at probably a selling opportunity. So here the market was pushing up, right? So the market was pushing up. So where did we see the shift in market structure, right? So at this particular point, you can see this is the major high, this is the major low. Right? I mean, this is the major high, right? So we can mark that. That's the major high. Okay, so this is the major low. So the moment the price breaks below the major low, here we have a change of character, right? So we have that as our change of character. So then what we need to do is wait for the retracement. So the first point, you can take the Fibonacci. So you mark from the highest to the lowest. Okay, from the highest to the lowest. So you can see the price coming to this level. Then we have a slight push before we see these push up. But remember, we have this change of character here. So if we have the change of character here, that tells you that maybe for those who trade the smart money concept, the high CT order blocks, this is a very nice order block, and we can explain the reason why the price comes to this level. It's basically to retest this order block. So if you look at it, it did not violate this high. This being the major high, this the major low that was taken out. The price coming or pulling back again to this level. These are deep retracement because they happen in the markets, and therefore you can be able to use these as your entry, right? You can be able to use that as your entry. So at this particular point, if you take your trade here, you can see the price pushed about 145 pips. So we can still say this level was respected because you are looking at day trading, maybe probably if you are a day trader. So this level was respected because if you're looking at setups for gold, how I treat myself, I look at 50 pips stop loss, 100 pips target. So this was very much well respected according to how I trade it. So, but if you want more, probably for this one, you can see the price retracing to this level, and then now we have that pullback. Okay, so you get that nice sell opportunity, and here you'll be talking, or we'll be talking about these being the entry, the stop loss being at this particular level, and therefore looking at the price coming to these liquidity zones here, right? These we have the liquidities here. So and that's a risk to reward ratio of about 1 is to 7.57. Okay, a very nice setup, and you can see the trade even continued pushing lower, right? The trade even continued pushing lower all the way to it even took out these lows here, right? Because this is where the market opened. That's why we have the low, the lows, the liquidities, the sell, the liquidities there. So it was a very nice push on the downside. Okay, so that's very significant. So if you come to the 15 minutes time frame, I mean 5 minutes time frame, you still get some entries around these levels, right? So the price pushes, right? So we have a retracement, then the price pushes, so creating these BOS, right? BOS. Then we have a retracement again to what? To this order block, right? So to this order block, we have the retracement to that order block, and here the price again drops, right? So we see another entry around this particular point, right? Because this is on the 5 minutes time frame. Okay, so it is very significant. Looking at these, you have to understand that it is very significant. Let me even show you where the market is currently. Okay, so we have this rally here, the price pushing up here, creating this particular BOS there. Then we see the price, this is a retracement, bringing the prices all the way to this order block, right? So, and then now we have this setup targeting 100 pips. So if your entry is here, and then you are looking at the price coming to this level, so that's about 111 pips, because here we have this liquidity. Okay, we have the London liquidity, which has been taken out now during the New York session, because you can see the New York session already kicking in there. So again, a very nice entry setup here. 1:2, right? Risk to reward ratio 1:2. So if this is our entry here, right? So our stop loss should be here, and targeting these highs there. So you see that's a risk to reward ratio of 1:2, right? Actually 1:3, right? 1:3, right? You comfortably have that, right? So very, very important, right? So that is very, very important. So what are we trying to say? So I've already shown you how to enter, how to exit. So whether irrespective of the strategy that you are using, you can even use the trend lines. Here we see that, right? We see that that is a trend line. Okay, that is a trend line. It has been respected actually severally here. Okay, let me show you. So that's a trend line. It has been respected severally. The price pushes up, comes back, pushes up, comes back, pushes up, comes back. But now this is not a healthy pullback, because one of the characteristics when the price is pushing up, before the pullback, I want to see the price do what? Create a BOS, then now pulls back. Like this is now a very healthy one. We see the price pushing up here, creating a BOS here. The price pushes up here, creating a BOS, then retracing back to the trend line. That is a very healthy pullback. Okay, so it is important to understand that. So, and when you look at these kind of pullbacks, basically they align very well with the smart money concept. Okay, because one of the things that you understand is that the pullback will happen when we have the BOS. Okay, the pullbacks will happen when we have the BOS, or the takeout of the sweep of liquidities. Okay, the sweep of liquidities. So as you confirm your entries, you need to confirm your entries when the price returns now to the premium levels. That is, if you are selling, and the discount level, and the price returns to the discount levels if you are looking for buying. Okay, so did I confuse myself? You need to look for sells if the price pulls back to the premium levels, and you need to look for buys if the price pulls back to the discount level. Like this is a discount level where the price pulled back to, so here you are looking for buying opportunity. Okay, so again, in terms of risk management, it's very essential of in terms of in trading. Of course, I'll keep you reminding this until it sinks in, because this is where most of the traders go wrong. So anytime you're trading, remember, don't risk more than 1 to 2%, 1 to 2% of your of your capital per trade. If you're using multiple, if you're taking multiple trades, again, ensure that you distribute the 2% within the multiple trades, such that the cumulative risk of your open position should not exceed 2%. Okay, so it's also good to adjust to manage a running trade. So once you, maybe probably like for me, how I do it, if I get to half of my target in profit, I usually take partial profit and put my stop loss at break even. This is basically to cushion myself such that in case the market condition changes, that I am able at least to get from that trade with something. That's what I usually say, securing the bags. So the other things that I want to pinpoint here is some of the key mistakes that we might be able, or that most of the traders do here. So that is entering a trade before confirmation. That is the number one trade. Remember, to confirm this pullback, so there has to be the three things that we talked about. We have to see a rally, then we have to see the pullback, and the pullback should respect the structure. So you can use the moving average, you can use the trend line, you can use the order blocks, or that is maybe and the market structure, lower highs and lower highs and lower lows for downtrend, and higher highs and higher lows for an uptrend. Okay, so and then now you can use those are good confirmations to be able to confirm a healthy pullback. Then misidentifying pullbacks in choppy markets, right? So in choppy markets, sometimes identifying the pullbacks might be risky. Okay, so the best way, like we defined how to identify a healthy pullback, is to look for the trend. So like you can see, the way we began here, we began by looking at the shift in market structure. All right, we began by looking at the shift of market structure here, so that now we can shift from this downtrend to uptrend. All right, and then now we align ourselves in terms of buying opportunities. Okay, so in a choppy market, again, also try to align yourself again with the market structure. Even though choppy market, there is a lot of fake outs, a lot of grab of liquidity, so maybe you can avoid trading the choppy markets, but if you trade, make sure that you follow all those characteristics. Okay, so never ignore the trend. Remember, the trend is your friend, so the overall trend really matters. Again, the reason why we began by identifying the shift in market structure, so that we can now shift from downtrend to uptrend. Even here, we began by looking at the change of character from an uptrend to downtrend, so that now you can start looking for selling opportunities. Okay, so it's also good to be wary of that, the fundamentals or the economic news before you take a setup. Be sure to look at the Forex Factory calendar to know what news are likely to come out and at what time that might impact the pair that you are looking, or the asset that you are looking to trade. Okay, so in summation, as I wind up, you need to understand key things that we have talked about. So pullbacks is equals to safe entries with strong trends. All right, safer entries with strong trends. And the key thing is to wait for the structure plus confirmation plus confluence. All right, so like I've always said, confluences are very important. Never take a trade if you only have one confluence. All right, so if you only have one reason, because one reason is not a confluence. So if you have one reason why you are buying or selling, that is not a high probability setup. There is no confluence there at all. So look for additional reasons why you should buy or sell, because with those additional confirmations or reasons, they usually increase the confluence, and the confluence comes with high probability trade setup. So being disciplined and patient to wait for the pullback is very important as well, because you have always seen instances where the traders see the impulsive move and they want to jump in and move with it, and the moment you jump in, what the market does is that it retraces. Now it's the time that it's giving you the pullback, and now you're in very big problem, very big drawdown that sometimes maybe you might not hold, because maybe you are leveraged, right? You used a higher risk than you could, because team always tells you don't risk more than 2%. You think that team really wants you to not to make money, right? So always ensure to trade smart, right? So trade smart, trade safer, master your pullback strategy today. So make sure that you're in a point whereby you're able to understand how to get the pullback. So if you got value from this video, make sure to like, subscribe, share, Comment as well in case you need anything that you want to need guidance with. I'll be able to do a video on this, and I believe this will be able to help you in your trading journey. So until next time, remember to stay focused, to stay disciplined, and to always trade with purpose.